Hello, I'm Andrew Chamberlain, the principal economist here at Gusto, and welcome to the August 2025 edition of The Economy Explained. Now, if you're a small business owner or an advisor, and you're wondering what is happening in today's economy and what it means for your business in the next few months, you are in the right place. So today, I'm going to tackle some questions that we often hear from our customers at Gusto. Is the economy really slowing down or going strong? What should employers expect for pay and benefits costs this year? Should I brace for tariffs? What are some tips that an economist can offer me to help my business make the most of today's economy? So with that said, let's go ahead and dive into this edition of The Economy Explained from Gusto. Let's start with the big picture. Now, despite all the headlines, the U.S. economy overall today is really standing tall with slow and steady growth and a healthy, although slightly cooling job market. Now, we're looking at a $30 trillion U.S. economy. That's about $88,000 per person. And although it's slowing, it's still growing at a healthy 3% clip as of June. That's enough to double the size of the American economy every 25 years. Now, it's hard to believe, but it's been 5 years since the last recession, and that was a 2-month tiny blip during the pandemic lockdowns. So before that, to go back to the last major recession, we'd have to go all the way back to 2009, after the financial crisis, fully 16 years ago. Now, since that time, both leading up to and since the pandemic, America has been in a slow, steady economic expansion. So as this picture shows you, at the 30,000-foot view, it's really important to remember that the U.S. small business economy is still in great shape historically. But, and this is important, there are definitely signs the economy today is slowing. Now, the last jobs report that came out in July, it was a lot weaker than expected. So far this year, the economy has only been adding about 85,000 jobs per month, just barely enough to keep unemployment from rising. And that's a huge change from 2022 and 2023, when hiring was happening at a breakneck pace and inflation and wage growth were surging. Now, today, we're seeing a rebalancing and a slight cooling of that job market. And for small businesses, this cooling is actually good news because it means companies will have an easier go of hiring and won't be thrown into these desperate bidding wars for talent that we saw after the pandemic. So this is really a rebalancing of the economy after that high inflation and hiring boom that we saw after COVID. So that is the biggest picture I can show you. Now, let's dial in on what this really means for your business. So I'm an economist, and the best way that I can understand how the economy will impact your company is by thinking of things like two sides of a coin. So on the one side, you've got revenue for your company, and the other side is your costs. And together, that is your full financial picture. So first, let's talk about the revenue side and what the economy is telling us today. Now, hands down, the single best number for understanding your company's revenue side is this: U.S. consumer spending. So that makes up about 70% of the economy. It's the best overall gauge of what's possible for small business growth in late 2025. Now, the good news is that despite a lot of uncertainty, consumer spending today is growing at a pretty healthy 5% annual clip. And as you can see in this figure, spending has been on an absolutely wild ride for the past few years, with a huge drop-off during the pandemic, followed by enormous growth through 2023. Now, today, you can see consumer spending is coming back down to earth, to normal pre-pandemic levels. So this is a welcome return to the normal times of consumer demand. So that's what's happening now. But what about the future? Well, consumer spending today is pretty healthy, but the future looks less rosy. So the best gauge of that future view is forward-looking consumer sentiment, which, according to a famous survey from the University of Michigan, fell sharply in 2025 as the job market slowed and tariff fears ramped up, as you can see here in this chart. Now, overall, U.S. consumer sentiment is down about 11% from a year ago as of June. And it actually fell every month of 2025 up until June. So that's actually the main reason that I think small businesses should be very cautious about their revenue forecast this year. But there is also some good news in these data. As shown here, consumer sentiment did tick up slightly in June. And, maybe that's a sign that fears about inflation, tariffs, and tech layoffs are finally starting to fade into the background. So looking at all these numbers, what's my takeaway for you as a small business owner or advisor? So here are three big ones that I see as an economist. First, although consumer spending is healthy, it's also likely to slow later this year. So in that environment, the smart move is to focus on customer retention rather than new acquisition. It's just a more cost-effective strategy. So investing in customer service and loyalty programs and relationship building, anything you can do that will give you a bigger bang for the buck than cash-heavy marketing campaigns is a really smart move in this environment. Second, with customer optimism kind of lagging, you should brace yourself for more discerning customers. American consumers famously get pickier about major purchases whenever sentiment slumps like we're seeing. So one way to get ahead of this is make sure your company's value proposition is crystal clear and consider if it's possible to offer different price points that may accommodate shifting willingness to pay. And then finally, anything you can do to diversify revenue streams is worth exploring in 2025. So is your business heavily dependent on discretionary spending? Well, if so, you can look for ways to add products and services that are viewed more as regular necessities. And doing so can really help you build a buffer in today's weak consumer sentiment, if that really does translate into a spending pullback in coming months. Now, let's go ahead and flip over to the cost side of your business. What is today's economy telling you about the expenses your business is likely to face in 2025? So here again, we have a mixture of both good news and less good news. So first, let's go ahead and look at the good news. Now, remember that summer of 2022 when inflation hit that whopping 9% annual pace? Well, thankfully those days are over. As you can see here, inflation is back down to around 2.7%. That's just a hair above the Federal Reserve's target of 2%. Now, as you know, inflation is a really big deal. Inflation is so hard on small businesses. They have thin margins. They cannot absorb wild cost swings like big companies can. Most small companies only keep enough cash on hand to cover about 2 weeks of expenses. So that post-pandemic inflation cost surge really put extreme pressure on America's small businesses. So thankfully, this return to normal inflation, it really means those days of shocking across-the-board price hikes for your business inputs is behind us. Well, except for tariffs. More on that in a minute. Going forward, your business can more confidently budget for modest operational cost increases in the 3% range without inflation fears that had business owners really sweating it out a couple years ago. Now let's talk about the bad news. Now, in many ways, loans are the lifeblood of small businesses. And even though the Fed has tamed inflation, interest rates are still way up. So what that means is that there's going to be higher costs for business loans in 2025. So here in this slide, we show you some typical rates for business loans today. As you can see, term loans are charging 7 to 8%, and that's double what they were a few years ago. SBA loans are in the 10 to 15% range, and then lines of credit, which are usually the most affordable option, are running at 6.5 to 8% on average. This means there's really a new economic reality for small businesses. Cash is going to be king, and focusing on positive cash flow rather than debt financing will really be a smart move in the coming months. So how long until these interest rates come down? Well, it's no secret why business loan rates remain so high. The Fed has been extremely cautious about returning interest rates back to pre-pandemic levels. And for good reason. That's the main tool the Fed has to fight inflation, which they've been doing since the pandemic. Now, the next Fed meeting is coming up in September. Most economists like me think they're going to start lowering rates then, partly because inflation is in check and because the broader economy is starting to slow. So until then, this is really a year for small businesses to focus on cash management in a big way. Now, let's talk about compensation. Now, you know that salaries and benefits are the biggest expense by far for most small businesses. And here we actually have some good news. So after 2 years of really surging growth in compensation and benefits costs, the total cost of employee salaries and benefits is coming back to earth. So it's growing around 4% annually. Now that's still a bit above the historical norm of about 3%, but it's more in line with normal compensation growth in the years before COVID. So budgeting for salary and benefit cost increases of around 4% this year looks like a pretty safe bet, according to our economists. Now, related to this is what is happening in the labor market. So when you go to hire, what should you expect to see? Now, 3 years ago, hiring was absolutely booming. So today, the job market is slowing. And there really are more of what economists call slack in the labor market. A really good way to see this is this picture here. This shows the number of unemployed Americans for every open job. So back in 2023, when the labor market was on fire, there was only about one half worker free for every job. So it's no surprise that hiring was so painful. But today that ratio is around 1-to-1, which means not as easy to hire as it was, say, after the 2010 recession, but it's going to be a lot easier than a couple of years ago. Now, for small companies, this means that hiring is going to feel different in the months ahead. It means that you can be more selective and measured in your hiring decisions this year. And it means those desperate bidding wars for talent are a lot less likely. For many small businesses who really struggled to hire in the past 2 years, this is going to be a really welcome relief. Now, let's talk about the biggest cost wildcard this year, tariffs. Now, as you know, things here are changing almost daily and definitely weekly. But as of today, the United States is looking at an average effective tariff rate of about 18.3%. Now, that's high. That's the highest since 1934. Now, any economist will tell you that a tariff is just a tax. So this is basically an embedded tax increase on any of your business inputs that come from exposed countries. Now, if your company is exposed to these tariffs through your supply chain, and most will be, you'll need to brace for this one-time cost increase. Now, the good news is that it is one time, and it won't likely boost overall inflation. But as with any tax increase, it definitely will require you to make business adjustments. So what can you do? Well, there's really no silver bullet, but here are some tactics that our economists recommend for trying to shield yourself from tariffs. Now, first is rethink your supply chain. Can you shift any business inputs away from affected countries? If so, now's the time to look for those alternative suppliers. Second, it's always worth looking for ways to renegotiate your supplier contracts. Now, some suppliers will be more willing than others to help absorb these costs, and those can help soften the blow on your business. Next, don't be surprised by your inventory. Don't let your inventory level surprise you. Make sure that you've budgeted for tariff impacts, and you know how the timing of your orders is going to line up with the rollout of those new tariffs, so you don't get a surprise bill when it comes time to restock. And fourth, now is really the time to delay or rein in any other costs. So are there opportunities to free up cash or delay some costs? If so, that's definitely a way to help offset tariffs. And finally, stay flexible. We've seen U.S. tariffs change overnight this year, and it's certain that future trade deals are going to keep those changes coming. So you should do what you can to keep your spending flexible. So what does this all mean for your small business? Well, we've walked through today's economy and what it means for your revenue side and then for your cost side. So let's go ahead and put those two sides back together into a playbook for you in the next few months. So here are 5 concrete things that after looking at the data, we can recommend based on what we're seeing in the economy today. First, a safe bet is to budget for 3.5% to 4% annual growth in total compensation costs. Those dramatic 6% growth rates of 2023 are behind us. And with falling inflation and a cooling job market, you can probably plan more predictably. So that's good news. Second, prioritize cash flow. So borrowing costs are still hovering at 7 to 15%. That means debt financing should be a last resort in 2025. Having a strong cash position today can be a real source of competitive advantage for you. Third, you're going to want to make the most of today's rebalancing labor market. You're going to want to prepare to be more selective about talent, focus on finding good fits for your culture and needs, a return to that about 1-to-1 ratio of unemployed workers per job opening. That's a sign of rising slack in the job market, and that usually means an easier time filling roles. Next, now is really the time to think hard about customer retention versus acquisition. So in a more cautious consumer spending environment, you got to keep existing customers. It's so much cheaper than finding new ones. So thinking about ways to sharpen up customer service and loyalty programs rather than cash-heavy marketing is a smart strategy. And then finally, now is the time to assess your tariff exposure if you haven't already. Look for ways to rework your supply chain, negotiate with your suppliers, and keep your spending plans flexible. there's a ton of uncertainty around tariffs going forward, so be prepared to stay agile. So that's all for this edition of The Economy Explained from Gusto. We hope that it helps you make the most of today's small business economy. I'm economist Andrew Chamberlain. We'll see you next time.